Low oil prices taking a huge toll on the mining sector, most notably BHP Billiton. For more now, let's go to Helal Miah, an investment research analyst at the Share Center. And Helal, let's talk about this. I mean, the company, this is the first loss that they posted in some 16 years. I mean, what's going on here?
Well, really, it's down to commodity prices, which have been sliding since 2011. Iron ore, copper, you name it. But BHP also has a fairly large exposure to the oil industry, especially in the US shale production area. And obviously, since mid-2014, oil prices have also taken even faster tumble. And so this is why we've seen their revenues and their profitability take a huge hit. So compared to last year, they've seen a roughly $7.7 billion impact on profits. So it's a huge decline. They are operationally, though, performing relatively well. So when looking at costs, whether that's in copper or the shale wells in America, and even coal, all of those costs are actually coming down. And companies have been forced to do this for a long, long time now.
Well, they've been performing relatively well, but they also cut their dividend by about 75%, which was, more than expected.
Yeah. The dividend, they've actually held on to the dividend, paying their dividend for much longer than some of the others have done. But they've really been forced, I think, now to cut the dividend because of the accident in Brazil, where they've actually had to take a fairly hefty write-down. So with a 75% cut in the dividend, I'd still say the fact that they are paying a dividend actually shows that they are performing relatively well, because we've seen the free cash flow of $1.2 billion. It's not too bad, but with regards to a dividend and going forward, they're adopting a constant payout ratio of 50% versus a progressive dividend. So this should actually be better for them in the medium to longer term, especially if oil and commodity prices stay lower for longer, which actually now they expect to happen.
And what's next for the company in your view? We have S&P already downgrading their credit rating and said that more downgrades may be coming.
Really, it's a case of preserving capital, preserving cash for the time being. And as and when the time is right, I don't think it will be in the next 6 months or the next year or so, but as and when the time is right and we see commodity prices stabilize and potentially see small upticks, I think this is a company that could be in a good position to make acquisitions of other big commodity giants.
All right, we're seeing oil prices around $32 a barrel. Where do prices need to go in order for BHP to return to profitability?
Well, shale gas production costs are slightly higher than where we are at the moment. We have seen BHP cut back by a relatively large amount over the last year in terms of the number of rigs that they manage. I would expect that oil prices need to be between $50 to about $65 a barrel for most of the shale producers to be profitable. But as time does go on, we do know that technology brings down the costs of producing oil. So that figure, 50 to 65, I think could actually come down in a short period of time.
All right, and very quickly, if I'm a shareholder in BHP or other mining stocks, what do I do now?
Well, I think most of the damage is probably done over the last 4 or 5 years, and obviously with the oil price taking a bit of a tumble. Apart from the likes of, say, Rio Tinto, BHP, we don't think it's worth holding on to some of the other companies, such as Glencore, such as Anglo American, because those companies really didn't manage their debts too well. They were overly indebted, whereas BHP Rio seemed to be better positioned. They didn't take out excessive amounts of debt. So for the time being, we're relatively comfortable on holding on to BHP. We think over the longer term, and it will take time for them to recover, there will be some recovery. But our preferred company at the moment is Rio Tinto, because they do actually have, in terms of iron ore, one of the lowest costs of production, and they seem to be better managed and have a better balance sheet.
All right, Helal Miah, an investment research analyst at the Share Center. Helal will continue to follow this. Thanks for your time.
Thank you.
I'm Scott Gamm, and you're watching The Street.